Welcome back to another video lecture of financial market and instrument. In our previous classes, we had discussed many things about the financial market. We know that what this financial system is, what is financial market, what are there in the financial market, and many other topics that we have already discussed. We have talked of commercial banks, and we have talked of insurance sector, we have talked of many other financial institutions. In today's class, we are going to learn something that is non-banking financial institutions. So, there are some institutions that are operating in the financial system that are non-banking sector. That means those financial institutions, they don't have the bank license, but they are rendering various financial services. We are going to read about those non-banking financial institutions. These non-banking financial institutions are a major contributor when we talk of this financial world and financial system. And you must have heard about various financial institutions and various financial services like venture capital, mutual funds, leasing, and so on. So, all these are actually these non-banking financial services. So, what these non-banking financial institutions are, what these non-banking financial companies are, and what are the things that are there in this non-banking financial institution, that is the topic of discussion of today's class. So, without much delay, let us start today's class. So, the non-banking financial institutions are the organizations that facilitate bank-related financial services, but does not have banking licenses. These NBFIs, that is non-banking financial institutions, do facilitate alternative financial services such as investment, risk pooling, financial consulting, brokering, money transmission, and check cashing. So, these NBFIs are a source of consumer credit. Along with the banking sector, these non-banking financial institutions are also source of consumer credit. These examples of non-banking financial system, if we will look into, they include the insurance firms, the venture capitalists, the currency exchanges, some micro loan organizations, and the pawn shops. These non-bank financial institutions provide services that are not necessarily suited to banks and serve as competition to banks and specialize in sectors or groups. If we see this non-banking financial institutions do facilitate alternative financial services such as investment, risk pooling, financial consulting, brokering, and money transmission and check cashing, as we have said. And these non-banking financial institutions provide services that are not necessarily suited to bank services as competition to banks and specialize in sectors or groups. So, what is the function of these non-banking financial institutions? So, if we will see that in the various sectors that we have discussed in the banking sectors, if we will say, and we had already discussed that this banking sector are the major contributor of the financial system or financial market, what we are saying, and lot of transactions are done in this banking sector. They are the intermediaries, or they are the major institution who are the intermediate between the savers and the borrowers, or the one who are seeking fund and those who are having the excess fund that we have already discussed. So, what is the necessity and what is the role of this non-banking financial institution in the financial market, and what is the function of this non-banking financial institution? So, let us have a look on that. So, in the functions of non-banking financial institutions, the first function that these institutions are rendering is as the financial intermediation. So, the most important function of this NBFIs is to intermediate and is to transfer the funds from the savers to the investors. So, this financial intermediation is economical and less expensive to both small businesses and small savers. So, if you will see, it provides funds to small businesses for which it is difficult to sell stocks and bonds because of high transaction costs, and it also benefits the small savers by pooling their funds and diversifying their investments. So, this is what we can say specifically the function of intermediation of this non-banking financial institution is, that they are promoting and they are, we can say, they are facilitating the small businesses and the small savers. The second important function of this non-banking financial institution is economic basis of this financial intermediation. So, this is what the function is, that they are giving economic basis. If we will see that the handling of funds by these financial intermediaries is more economical and more efficient than that by the individual wealth owners, because of the fact that financial intermediation is based on two things, that are the law of large numbers and economics of scale in portfolio management. So, these are the two economic basis of the intermediation. If we will see what is this law of large number is, if you will see that the financial intermediaries operate on the basis of the statistical law of large numbers. So, according to this law, not all the creditors will withdraw their funds from these institutions. Moreover, if some creditors are withdrawing cash, some others may be depositing cash. Again, the financial intermediaries also receive regular interest payments on loans or investments made by them, and all these factors enable the financial intermediaries to keep in cash only a small fraction of the funds provided by the creditors and lend or invest the rest of the fund. So, this is what the basis of the law of large number is. Now, another aspect of this is the economies of scale. So, it is saying that the large size of the asset portfolios enables the financial intermediaries to reap various economies of scale in portfolio management. And the main economies are reduction of risk through portfolio diversification, employment of efficient and professional managers, low administrative cost of large loans, and low cost of establishment, information and transactions. So, this is what the law of large number and economies of scale is. The next function of NBFI is the inducement to save, and the non-banking financial intermediaries play an important role in promoting savings in the country. That what is the function we are talking of, and these savers need stores of value to hold their savings in, and these institutions provide a wide range of financial assets as store of value and make available expert financial services to the savers. So, as the stores of value, the financial assets have a certain spatial advantages over the tangible assets, such as the physical capital, inventories of goods, etc., and they are easily storable, more liquid and more easily divisible and less risky. So, these are the things which make, in fact, saving income ratio is positively related to both financial institutions and financial assets. So, this financial progress, this induces large savings out of the same level of real income. So, that is what is the inducement to save is, which is an important function of the non-banking financial institutions. Next function of NBFIs is that it works as the mobilizer of saving, or it executes the function of mobilization of saving. So, mobilization of savings that we had many times discussed takes place when the savers hold savings in the form of currency, bank deposits, post office savings deposits, life insurance policies, bills, bonds, equity shares, etc. So, these are the forms by which the savers are mobilizing their savings to an productive avenue. This NBFI provides highly efficient mechanism for mobilizing these savings, and there are two types of NBFIs involved in the mobilization of saving. They are the depository intermediaries such as the savings and loan associations, credit unions, mutual savings banks, etc. And these institutions mobilize small savings and provide high liquidity of funds. And the second one is the contractual intermediaries such as life insurance companies, public provident funds, pension funds, etc. And these institutions enter into contract with savers and provide them various types of benefits over the long period. So, if in a nutshell we will say this non-banking financial institutions move the savings of the savers to the productive avenues in two basic forms or in two basic types. One is in short term form, that is depository intermediaries or other short term saving schemes, or in an long term investment avenue or long term investment schemes that are there for a longer period of time. Apart from that, the non-banking financial institutions also operate or function as an investment of funds. So, the main objective of these NBFIs is to earn profits by investing the mobilized savings, and that is what for it is functioning. And for this purpose, these institutions follow different investment policies. For example, if we see that the savings and loan associations, mutual saving banks, investment in mortgages, while insurance companies invest in bonds and securities. So, these are the investment avenues that are there with the non-banking financial institutions, and that is how the non-banking financial institutions are functioning. So, we see that non-banking financial institutions are working as the mobilizer of the savers, and they are the intermediary between the savers and the investors. And they are giving many schemes of short term and long term investments to the investors, and they are generating fund out of that. They are ultimately working as an mobilizer of the savers, not only the savers, but they work as the mobilizer of the economy of the country. They are the major contributor of the economy of the country. So, this is what the function of the non-banking financial institutions are. Now, what are the categories or how these non-banking financial institutions are operating? What are the institutions, those which are providing this non-banking financial institutions, and what are the things that are included in this non-banking financial institutions? Let us have a look on that. What are the types of non-banking financial institutions? So, if you will see this non-banking financial institutions can be broadly or majorly categorized into three categories, that are either they are risk pooling institutions, or they are contractual savings institutions, or there are some other non-banking financial institutions according to the type of operation they are doing. So, now we will discuss one by one that what are these types of non-banking financial institutions. The first is the risk pooling institutions. So, if you will remember that when we are talking of the insurance sector, or when we are talking of this insurance, so then in insurance we are talking of that they are the risk pooling or risk management tools. So, this insurance sector is definitely not the banking sector, or they are not banks. They are the companies, or they are the institutions, those which are working as the risk hedging institutions. They are pulling the risk of a group of people, those who are endangered with a similar type of risk, and they are catering services to them, or they are covering the risk that is there with the insured ones. So, that is what insurance sector is doing, and this insurance sector, when is not a banking sector, it is definitely a part of the financial institution, and this insurance is definitely a part of the financial system, and this is included in this non-banking financial institution and under the category of risk pooling institutions. So, if you see, this insurance companies underwrite economic risk associated with death, illness, damage to or loss of property and other risk of loss. So, they provide a contingent promise of economic protection to the cases of loss, and there are two main type of insurance companies that we have discussed, either they are life insurance or they are the general insurance. So, this general insurance tends to be short term, while life insurance is a longer contract ending at the death of the insured. So, this is what general insurance and life insurance is, and in both these types of insurance, life and property are available to all sectors of the community. So, because of the nature of the insurance industry, these insurance companies enjoy a high level of information efficiency. And the life insurance companies insure against economic loss of the insured's premature death, and the insured will pay a fixed sum as an insurance premium every term, and because of the probability of death increases with age, while premiums remain constant, the insured overpays in the earlier stages and underpays in the latter years. The overpayment in the early years of the agreement is the cash value of the insurance policy. So, this is how the insurance sector is operating, and this is how the non-banking financial institutions are working and pulling the risk of the group of people, those who are endangered with a similar type of loss. So, this is what the type of insurance, the type of non-banking financial institutions if we categorize under the risk pooling factor. Now, this general insurance is further divided into two categories, one is market and one is social insurance. Now, this general insurance companies take a single premium payment and social insurance is against the risk of loss of income due to sudden unemployment, disability, illness and natural disasters. So, because of the unpredictability of these risks, the ease at which the insured can hide pertinent information from the insurer and the presence of moral hazard, private insurance companies frequently do not provide social insurance. A gap in the insurance industry which government usually feels is there because of this. So, the social insurance is more prevalent in industrialized Western societies where family networks and other organic social support groups are not as prevalent. So, this market insurance is privatized insurance for damage or loss of property. So, this is what the two types of general insurance are, that are there, either that are market insurance or they are the social insurance. So, this is what the insurance sector is. So, next category of non-banking financial institution, if we will see, they are on the basis of the contractual savings institutions. So, the institutions, those who are categorized on the basis of the contractual savings. So, these contractual savings institutions, which are also called as the institutional investors, provide the opportunity for individuals to invest in collective investment vehicles in a fiduciary rather than a principal role. So, collective investment vehicles invest the pooled resources of the individuals and firms into numerous equity, debt and derivatives promises. So, the individual, however, holds equity in the CIV itself rather than the CIV invest in specifically. So, the two most popular examples of contractual savings institutions, if you will see, they are the mutual funds and the private pension plans. So, these two main types of mutual funds, if you will see, they are open-ended and close-ended funds, and open-ended funds generate new investments by allowing the public buy new shares at any time. Shareholders can liquidate their shares by selling them back to the open-end fund at the net asset value. And the other hand, the closed-end funds issue a fixed number of shares in an IPO. And the shareholders capitalize on the value of their assets by selling their shares in a stock exchange. Thus, this is what the types are. And these mutual funds can be delineated along the nature of their investment. For example, if you see, some funds make a high risk, high return investment, while others focus on just tax exempt securities. Still, others specialize in speculative trading, that is hedge funds, and various other investment avenues are there. The pension funds are mutual funds that limit the investors' ability to assess their investment until after a certain date. So, after a certain date, their investment is stopped. So, in return, the pension funds are generated large tax breaks in order to incentivize the working public to set aside a percentage of their current income for a later date when they are no longer amongst the labor force. So, this is what the pension fund and the other fund is. Apart from that, there are some other non-banking financial institutions that market makers are broker-dealer institutions that quote both a buy and sell price for an asset held in inventory. Such assets include equities, government and corporate debt, derivatives and foreign currencies even. So, once an order is received, the market maker immediately sells from its inventory or makes a purchase to offset the loss in inventory. So, the difference in the buying and selling quotes or the bid offer spread is how the market maker makes the profit out of. The market makers improve the liquidity of any asset in their inventory. The specialized sectoral financials provide a limited range of financial services to a targeted sector. So, for example, if we will take the leasing companies provide finance for equipment, while real estate financials channel capital to protective home owners. So, these leasing companies generally have two unique advantages over other specialized sectoral financials. They are somewhat insulated against the risk of default because they own the leased equipment as part of their collateral agreement. Additionally, these leasing companies enjoy the preferential tax treatment on equipment investment, and other financial services provides include brokers, management consultants and financial advisors, and they operate on a fee or service basis. So, for the most part, financial services providers improve informational efficiency for the investors. However, in the case of brokers, they do offer a transaction service by which an investor can liquidate existing assets. So, this is what is the non-banking financial institutions are. These are the functions of the non-banking financial institutions, and these are the broad categories of the non-banking financial institutions. So, in today's class, we learned about what the non-banking financial institutions. We know that these non-banking financial institutions are the major contributor of the financial market, although they don't have the banking license and they can't take deposit from the public. They are rendering n number of services. In our upcoming classes, we will be discussing many more things. For today, this is all. Thank you.